Today, we're going to take a higher level look at reverse mortgages in general, but also talk about some specifics of the home equity conversion mortgage. And the idea is to give you a better overview of the entire program to see if it's something that might be a fit for you. And remember, always check with your family and a licensed financial professional before you make this or any other major financial decision. Now, sit back and get ready to learn the truth about reverse. If this is your first time here, please like this video, subscribe to the channel, and be sure to tap that bell for notifications so that you can keep learning right along with us. Those over age 62 have amassed more than $13 trillion in home equity, and it largely sits idle during retirement. My name is Brian McRae, and as a retirement mortgage specialist, I work with my clients every day to position all of that home wealth in the most advantageous way possible. If you have questions about reverse mortgages or the home equity conversion mortgage, or you would like more information, please feel free to reach out. My contact information is in the description right below. I'll be happy to help you anytime. Welcome back to The Truth About Reverse, and we're in a little bit of a different setting today. This is more of a classroom type setting for part one of what will be a multi-part introduction to reverse mortgages and also the home equity conversion mortgage. My name is Brian McRae. I'm a retirement mortgage specialist with Fairway Independent Mortgage. I work exclusively with those over 62 to help them reposition home equity and live their best retirement. So today we're going to talk about reverse mortgages in general, kind of some of the general terms, general overview, but also about some of the specific points of the home equity conversion mortgage. And the idea is to give you enough information to see if this might be a program that could possibly be a fit for you. Now, first of all, this program was designed for those who are looking to age in place and looking to put a safe and intentional portion of their home equity to work in retirement. So the minimum age is 62. So we're looking for those who are near or in retirement. And if you're concerned about things like market volatility, or in today's world, inflation is a very real concern. Longevity risk is something that we're all concerned about because we're all living longer lives. And so outliving your savings can be a big concern. And you might be among the 40% of retirees who is still making a mortgage payment, which means you're sending money to the mortgage company despite the fact that you're on a fixed income. And finally, you might be concerned about the suitability of your home. Is it practically efficient, practically effective to age in place safely? What exactly is a reverse mortgage? Most importantly, it's just a mortgage. And so a lot of the fear and uncertainty and doubt and myths about the reverse mortgage can really be allayed by understanding that this is just a type of mortgage. A mortgage is a lien against your home that requires a specific debt to be repaid, and the reverse mortgage is no different. Now, there are a couple of rules. It functions differently than a traditional mortgage, but by and large, it works just like any other mortgage does. So the specifics, remember, this was designed for those who are looking to age in place. And so you have to be 62. It's designed for those who are in or near retirement. And the fundamental idea is that the home equity conversion mortgage converts a safe and intentional portion of your overall home equity, typically between 40 to 60% of the overall value of the home, and converts that into a tax-free line of credit that you can use for just about anything. Now, if you're using it to replace your traditional mortgage, we would use the line of credit to pay off that mortgage. Now, the home equity conversion mortgage does not require a monthly principal and interest payment. And so one of the biggest financial advantages can be replacing your traditional mortgage, where you're making hundreds, if not thousands of dollars in payments every month, with the home equity conversion mortgage, where the principal and interest components of those now go away. Now, you still have to pay all of your property charges. So you got to pay your property taxes. You have to pay your homeowners insurance, have to pay your HOA fees and any other associated property charges. But the principal and interest component of that payment goes away. Generally speaking, as soon as I say the words reverse mortgage, you're probably thinking, isn't that the loan where the bank gets your home in the end? And that's what everybody thinks. It's one of the most pervasive myths about reverse mortgages. And in my opinion, one of the most damaging, because it keeps us from considering this very valuable vehicle. Because the truth is, you own the home. Just like any other mortgage, it's just a loan. It's just a lien against the home that the loan has to be satisfied at the end. But you, the owner or the heirs or the estate, are entitled to the equity. You're still in the deed. You still own the home. You can still sell, refinance, just as you would with any other mortgage. The HECM is a type of reverse mortgage. This instrument was constructed from the ground up in 1989 to allow those over age 62 to access a safe and intentional portion of their home equity to help them get through retirement. It is the most widely used reverse mortgage program in the United States. Fortunately for you, the consumer, the home equity conversion mortgage is likely the only reverse mortgage program that you'll be able to use. Now, there are a couple of lenders who offer proprietary reverse mortgage programs, but they are generally for higher dollar value properties. By and large, most of the reverse mortgages out there are the home equity conversion mortgage. Now, this loan is guaranteed by the federal government. It's an FHA loan. And as I mentioned, it was designed for those who are looking to age in place, looking to use a portion of their equity to help them get through retirement. And so that being said, the minimum age is 62. Leads to another one of the biggest myths about reverse mortgages, and that's my estate or my heirs are going to be left with a big bill at the end. And that's also not true. Two reasons for that. Number one, because we're only offering up between 30 to 60% of the home's overall value at the time of the loan. It's extremely rare for you to be able to consume all of your home equity over the life of that loan. However, if you are one of the outliers and at the very end, the home's value is not enough to cover the amount that's owed, well, that outcome is protected. It's actually insured, part of the guarantees of this program. And what I mean by that is this is a loan of no recourse. And this means only the home can be used to stand for this loan. And so if you get to the end and the home's value is not enough to cover the loan balance, insurance steps in and covers that gap. So there's no recourse against the borrowers or their heirs if the home's value, for whatever reason, should come up short. So contrary to popular belief, the modern reverse mortgage is one of the most highly regulated loan programs out there and offers numerous protections to the consumer, like this no recourse feature. Here are some other examples of how highly regulated the home equity conversion mortgage is, along with some of the specific regulations. First of all, and this is among my personal favorites, is that borrowers have to receive counseling during the loan application process. And this counselor has to be an independent third party. This counselor's job is to make sure that the borrowers understand both the reverse mortgage in general, but also the specifics of their loan in particular. And so it's another set of eyes that's not attached to the loan. And this counselor is an uninvested third party. Their job is to make sure that the borrower understands both the basics of the reverse mortgage and the particulars of their loan. In addition to only offering up between 30 to 60% of the home's value in total, there are also some initial disbursement limits. In the first year, you can only take up to 60% of the available balance. And my favorite feature of the home equity conversion mortgage is this line of credit. There is a significant growth feature attached to it that will help you grow liquidity from your home equity. This has been the subject of numerous videos, and I won't spend a whole lot of time on it here in this overview course, but the line of credit growth on a paid off home can be a significant way to build real liquidity over time. And this can be one of the most valuable financial planning points for your financial advisor because they may not be considering the home's value actively in their retirement portfolio right now. This leads to our next myth. Aren't reverse mortgages a loan of last resort? And the answer is a resounding no. They used to be. They used to be considered a loan of last resort as something that you would do if you were in dire straits financially. And there is, I think, a social reluctance to the idea of even using home equity. My parents and my grandparents were trained to pay off their homes. And by and large, the last two generations of people have stored a massive amount of wealth in home equity. And it largely sits idle during retirement. And so, contrary to popular belief, the modern reverse mortgage, the home equity conversion mortgage, was designed from the ground up to allow those over age 62 to access a safe and intentional portion of their home equity. Now, if you're among those who have a significant amount of home equity, if you've got, say, more than 50% equity in your house, I would imagine that this represents one of, if not the largest source of wealth in your portfolio. And yet, odds are you're probably not using it. And in the aggregate, those over age 62 have amassed more than $13 trillion in home equity. And it largely sits idle during retirement. And that is the fundamental purpose of the home equity conversion mortgage. So let's talk about who qualifies. This is a very specific program, and it is designed for those who are in or nearing retirement. And so the youngest you can be is 62 years old. And only your primary residence is eligible, so no vacation homes or second homes, because you do have to occupy the house. And you need to have at least, say, 50 to 60% equity in the home for the numbers to make sense. Otherwise, you're bringing a significant amount of money to closing, and the numbers typically don't bear themselves out. Finally, this is not a program that's designed for short-term use. So if this is a home you're only going to be in for the next 18 to 24 months, there might be better ways to access the equity. The home equity conversion mortgage is more designed as an age-in-place vehicle. The economics really bear themselves out the longer you stay in the home. When you're working hand in hand with a financial advisor with the home equity conversion mortgage, the financial advisor has a number of different strategies that they can use to integrate these funds. They might use the home equity conversion mortgage and the proceeds to help keep your income low because the line of credit is tax-free. So it's not counted as income, it's counted as debt. And that might help your traditional retirement funds last a little bit longer, helping mitigate that longevity risk because, as I mentioned earlier, we're all living longer lives. And then finally, and this is something that the majority of my clients are dealing with, is long-term care. 70% of us are going to need long-term care at some point. And it's been my experience that those who need long-term care will wind up using their home equity in some form or fashion. And so putting this in place early as a hedge against long-term care, and then also having this line of credit available when it's time for the long-term care expense can go a long way towards helping you be prepared for that event. There's a significant body of research around exactly how best to integrate the home equity conversion mortgage into the retirement plan. And it's led by Dr. Wade Pfau. Dr. Wade Pfau is a professor at the American College of Financial Services, and he actually ran the Retirement Income Certified Professional Program. RICPs work on the retirement side of retirement, helping you draw down your retirement portfolio in the most effective fashion possible. And so Dr. Pfau has a very specific strategy for integrating the reverse mortgage into any retirement portfolio. So if you're in or near retirement and you are looking for ways to protect against longevity risk, to mitigate potential long-term care expenses, the fundamental idea here is to position your home equity. Because if you're among those who have that portion of $13 trillion of home equity, odds are it's not being used right now. And so the home equity conversion mortgage is the instrument that allows you to position a safe and healthy portion of that home equity to take full advantage of it within the context of your retirement portfolio. Reverse mortgages aren't for everyone, but in the right circumstance, they can be an extraordinarily powerful financial tool to help you thrive in retirement. I hope today's video helps you understand reverse mortgages and also the home equity conversion mortgage at a little bit more of a higher level. And ideally, these concepts will help you make a really informed decision about whether or not the home equity conversion mortgage might be a good fit for you. As always, thanks for watching and thanks for your continued support. Until next time, keep on learning the truth about reverse.